joining us right now. Manish, thanks very much. Great to have you here. Prashant this side. Manish, first of all, there was a bit of relief that there was no blanket moratorium as far as the announcement from RBI today is concerned. And the stocks reacted briefly after that. But where does it leave us, even after all that the RBI has announced? I mean, liquidity support, etc. Are things, would you go with the school of thought that, most of these large banks have raised capital, they've been stress tested from wave one of COVID, so they should be okay this time around as well? Or you think, the outlook has once again become a little uncertain?
Okay, let me try and give a little more holistic picture. One is, I think the RBI announcements were meant to specifically benefit certain smaller segments, smaller companies in the MFI space, and so forth. Second, by announcing the second tranche for G-sap or the G-sap or the G-sec acquisition program, as they call it, they are also trying to signal that, while inflation may be going up, yet they believe in keeping easy money policy right now for reasons that is well known to us. So in a way, it was more of a confidence boosting measure by RBI. And at the same time, they are also trying to say, look, the economy may have certain challenges, but the challenges are not as significant as they were a year back. Banks are better prepared, they're better capitalized. So right now, probably he does not feel the need for taking certain measures which were taken last time, because some of those measures can also be associated with certain moral hazards of borrowing, right? And therefore, in a way, markets were actually quite happy with the measures that were taken by RBI.
Okay, fair enough. Manish, good afternoon. How are you looking at things? Because we've largely, 5% off the highs despite this massive humanitarian crisis that's playing out. Now, in terms of building a portfolio, are you keeping it more defensive and, let's say, sticking to IT and pharma? Or are you in the camp that is sort of seeing this through and you'd rather buy economy-facing stocks at the moment?
Well, it's a very interesting question, Surbhi, and let me try and give you a little more insight on how we have been managing it in the last 1 year. Ever since COVID struck and there was a lockdown, we realized that the narratives could be changing quite rapidly in the absence of the numbers for the June quarter, because it was sort of a vacuum, something which we had not experienced in the past. And actually, it happened like that. So initially, the market moved towards consumer, followed by pharma, then personal mobility, followed by technology. And in the last few months, we have seen how the commodities, both cement and metals, have behaved. So it has been a sort of a year in which narratives have been changing almost every 2-3 months. And therefore, the call that we took was, look, at the portfolio level, we will not be carrying significant sectoral deviations, except where we have very high conviction. But within each sector, we'll try to either stick to leaders or stick to those companies which are going to be demonstrating better resilience, better balance sheets, better growth, and so forth. So, for example, if you look at our portfolio, you will actually see that in every sector, whether it is technology, you will see that there will be 2 or 3 companies where we'll be heavily loaded. Likewise in cement, likewise in metals, and so forth, or even in banking. So in a way, we have chosen not to take significant sectoral bets, but yes, at the margin, wherever we had greater conviction, yes, you will find certain deviations. So for example, cement, as such, we have been running overweight for the last 1 year or so. Autos, at the margin, we have been running underweight for most of the last 6 months, primarily because we were quite positive on metals and commodities, and we felt that the entire personal mobility theme was broadly done with. So at the margin, we have made certain small deviations, but as such, it's a portfolio which is carrying small deviations with respect to sectors. Also, if I can add another flavor to that, we also took a call that while we do not know that when this COVID is going to end, so while a large part of our portfolio would be invested in more secular and stronger businesses, we'll also be investing a small part of the portfolio in those companies where the sectors are adversely impacted, but we believe the companies will emerge stronger post-COVID. So for example, retail or say airlines, these are the sectors which are really adversely impacted by COVID. But then there are certain companies which we believe will only be emerging stronger out of the crisis. So you will also find some of those exposures also in the portfolio.
Okay, that's a really interesting approach, that you're going for the battered sectors, but the strong players in those battered sectors. That's quite an interesting one. So in the same light, then let me ask you about consumer discretionary. I take your point on auto. If metals are going up, that's clearly not good news for OEMs. But in discretionary, would you buy anything else right now beyond some of the themes that you've mentioned?
So in the discretionary space, we have, so you are referring to auto. Discretionary is quite broad. It can be referred to sectors like auto. It could also be referred to sectors like jewelry. So we are present in the space, but as I said, in autos, we are underweight. And within that, we are more underweight two-wheelers space because there the volume impact is higher. And on the other discretionaries like jewelry or say, for example, some of the other consumer durables, we would be either overweight or sort of neutral in some of the companies.
Okay, got that. What about the high-flying urban stocks of the yesteryears? I mean, it's been a while, right? I know you're not going to get into stocks, but the flavor that I'm talking about is your Page Industries, Jubilant FoodWorks, PVR. That whole theme that was the toast of the market back in, I think, 2017.
So some of those themes have been actually adversely impacted, and therefore in line with our philosophy. If you look at our portfolio, you'll be seeing them in small weights there. So maybe 30 bips, 50 bips, 100 bips and things like that. They are not going to be a sizable part of our portfolio right now, simply because we need to also manage the journey. I think it's important that while we may like some of these businesses from a long-term perspective, we need to manage the current journey. Also, some of these themes are not really very cheap, despite the disruption that we are seeing to their business.
Right. Manish, just a broader sort of, earnings question, earnings expectations question. We've already started to see some earnings downgrades come through. Do you think this can, stretch on for a bit longer and deeper? The reason is that unlike last year, this year we've basically seen younger people get impacted because of COVID, right? I mean, people around us and all of us would know of someone either nearby or not so nearby where people, in their 20s, 30s, 40s have got impacted. This was not the case last year. Last year it was mostly older people. How will that tie in into when restrictions get lifted after this peak passes, the propensity of younger people to go out, consume, spend, etc. There is one school of thought which believes that people will wait for vaccinations now, and if that is the case, it will take time. I mean, even Serum has said that vaccine supplies will only ease up meaningfully post July this year. So, what is your sense in terms of how all of that will feed into earnings for FY22?
I think, Prashant, you have made some very important and interesting observations. So one, at least when we entered the current financial year, we were entering with fairly high set of expectations on the back of the earnings momentum that we saw in the December quarter and to some extent even in the September quarter. So on the back of those expectations and given the low base of the June quarter, market was sort of anticipating an earnings growth of over 30% for FY22. So first of all, plain and simple, are we going to see an earnings downgrade? Answer is yes. And you don't need in rocket science to say that, right? So all of us understand that this June quarter, while we were hoping that it would be very good on the low base of last year, is unlikely to turn out to be as good as last year, as good as we were anticipating, although the level of disruption is still going to be much lower than what we had experienced last year. And that's simply because the companies are better prepared. they're able to navigate better. We are not having a complete lockdown. It is very localized. Manufacturing is not disrupted much. Yes, the local consumption may have been disrupted, but we have also seen that some of these consumption also come back. So there could be some postponement in demand from June or September quarters to December or March quarters. So that can also happen. But it is the impact is not going to be as high as it was last year. So overall, if I have to summarize, the COVID impact on humanity is going to be far more severe this year as far as India is concerned. However, the actual financial impact on the companies in the listed space, and I caveat here, companies in the listed space may not be as severe as it was in the June quarter of last year, simply because the companies are better prepared. We know how to navigate ourselves through the various channels, including the digital channels. So that way, there will be an element of downgrade, but it may not be as serious as one may fear looking at the number of COVID cases.
Okay, that's well put. Thank you. Good talking to you, Manish. Thanks very much for taking up the time. You stay safe and take good care. And we look forward to our next conversation soon. Well, there you go. That's a view from ICICI Prudential Life Insurance Company coming in on how they're looking at their portfolios and how they're managing money in the market right now. We do have to take a very quick break. With the news, the market's holding up really well, actually. The Bank Nifty is firing away, 460 points higher. The Nifty itself is up a whole 100 points. So it's turning out to be a pretty decent afternoon for the bulls. We'll take a break on that note. And on the other side, if you are interested in the auto ancillary space, you might want to hear these snippets. We caught up with two important companies, GNA Axles as well as Minda Industries, to figure out how their business is coping up in these troubled times. So we'll analyze those stocks. And then, of course, Nimesh comes in, tells us what the buzz is in the dealing rooms today. D Street Chatter coming up, along with some trading calls for the last half hour with Mitesh.